Imagine you send a dollar stablecoin from your wallet to a friend, and suddenly everyone online is asking the same question. Does the government now require an ID check for every stablecoin transfer? That is the confusion around the new US stablecoin customer identification proposal. The short answer, as currently drafted, is not every wallet-to-wallet transfer. The proposal is aimed at permitted payment stablecoin issuers when they open direct customer relationships, like issuing, redeeming, or holding stablecoins for a customer. That difference matters. Because stablecoins are no longer being treated only as crypto tokens that try to track $1, in US policy, they are moving toward regulated payment infrastructure. And once something starts looking like payment infrastructure, the rules begin to look much more like bank rules. On June 18, 2026, the Federal Reserve and 4 other US agencies requested public comment on a proposed rule for customer identification programs at permitted payment stablecoin issuers. The proposal was published in the Federal Register on June 22, 2026, which moved it into the formal rulemaking stage. So this is not a final rule yet. It is a proposal, but it shows where regulated digital dollars may be going. To understand it, forget the crypto headlines for a moment and picture 2 doors. Door 1 is the issuer door. You go directly to a stablecoin issuer, open an account, send dollars in, receive stablecoins, redeem stablecoins for dollars, or use custody services from the issuer. Door 2 is the open market door. You already have stablecoins in a wallet. You send them to another wallet. You use them in a smart contract. You receive them from an exchange, a customer, a friend, or a payment app. The proposed identity rule is mainly about Door 1. That does not mean Door 2 is completely unregulated. Exchanges, custodians, and other financial intermediaries may have their own legal obligations. But the stablecoin issuer itself is not being told in this customer identification proposal to identify every person who ever touches one of its tokens on-chain. That is the key misconception to avoid. Now, let's define the main character in plain English. A permitted payment stablecoin issuer, often shortened to PPSI, is an issuer that fits into the US framework created by the Genius Act. The Genius Act does not cover every token that calls itself stable. It focuses on payment stablecoins, which are intended to be used as dollar-like payment instruments under a regulated issuer framework. A permitted issuer is not just a random smart contract creator saying, "Trust me, this is worth $1." It is an entity allowed to issue payment stablecoins under the rules with oversight, reserve requirements, and compliance duties attached. Think of it like the difference between a homemade paper coupon and a prepaid card issued under a regulated financial program. Both may promise value, but one sits inside a supervised system. The new proposal adds a familiar piece from traditional finance, a customer identification program, often called CIP. If you have ever opened a bank account, brokerage account, or major crypto exchange account, you have probably seen something similar. The company asks for your legal name, date of birth, address, and an identification number. It may ask for a driver's license, passport, business documents, or other records. It may verify the information using public databases, consumer reporting agencies, or other non-document methods. The point is not just to collect a name on a form. The point is for the institution to form a reasonable belief that it knows the true identity of its customer. Under the stablecoin proposal, the issuer would need written procedures for that process. It would need to keep records. It would need to check whether a customer appears on certain government lists of known or suspected terrorists or terrorist organizations. It would need to tell customers that it is requesting information to verify identity. And it could, under conditions, rely on another regulated financial institution to perform parts of the process. In simple terms, if a permitted stablecoin issuer opens accounts directly for customers, the issuer would need a bank-style identity program around those accounts. Here is where the crypto part gets interesting. Stablecoins live in 2 worlds at once. In the issuer world, dollars or dollar-like reserve assets sit behind the token. The issuer creates tokens, redeems tokens, manages reserves, and may provide custody or related services. In the blockchain world, tokens move between addresses. A smart contract records balances. Your wallet signs transactions with a private key. The blockchain can show that address A sent tokens to address B, but it does not automatically know that address A is your phone, your hardware wallet, or a company treasury wallet. That split is why regulators talk about the primary market and the secondary market. The primary market is when the issuer interacts directly with a user or holder. For example, a customer opens an issuer account, wires dollars to mint stablecoins, redeems stablecoins for dollars, or uses issuer custody. The secondary market is when stablecoins move without the issuer being a direct party, other than the token's smart contract doing what it was coded to do. For example, you buy stablecoins on an exchange, send them from your self-custody wallet to a vendor, or swap them in a decentralized application. The proposal says that mere ownership or control of a payment stablecoin by itself does not create an account relationship with the issuer. It also says that activity that does not directly involve the issuer as a party, other than through a smart contract, is not the kind of account relationship this CIP rule is targeting. That is a very important boundary. If this channel helps you make sense of crypto policy without the panic and hype, consider subscribing. We keep the focus on what the rules actually say, what they do not say, and why the plumbing matters. Now, let's make it concrete. Suppose a large trading firm has a direct account with a permitted stablecoin issuer. The firm sends dollars to the issuer and receives newly minted stablecoins. Under the proposal, that firm is likely the issuer's customer. The issuer would need to identify and verify it according to its written program. Now, suppose a retail user buys that same stablecoin on a crypto exchange and sends it to a friend's self-custody wallet. Under the proposal as drafted, that transfer does not automatically make the sender or receiver a customer of the issuer. The exchange may have identified the retail user under exchange rules, but the issuer is not being required by this SIP proposal to identify every wallet that later receives the token. Now, suppose that same retail user wants to redeem stablecoins directly with the issuer for dollars. That is different. If the user goes to the issuer door, the issuer may need to open an account or direct relationship, and the user may become a customer for CIP purposes. So the practical impact depends on where you touch the system. If you only hold or transfer a regulated stablecoin through wallets and third-party platforms, the issuer-level ID rule may not directly change your wallet-to-wallet experience. If you want direct issuance or redemption from the issuer, expect identity checks. If you are an exchange, market maker, fintech app, institution, or payment company connecting directly to the issuer, this rule is much more central. This is why many everyday users should care, even if they never open a direct issuer account. The rule may shape which stablecoins payment apps choose to support. It may shape how easy redemption is. It may shape whether smaller issuers can compete with large issuers that already have compliance teams. It may also shape how regulated stablecoins plug into banks, card networks, brokers, merchant services, and cross-border payment systems. The benefits are easy to understand. If stablecoins are going to act like payment rails for businesses, institutions, and consumers, regulators want stronger defenses against money laundering, sanctions evasion, terrorist financing, scams, and stolen funds moving through dollar tokens. A clear CIP rule can make banks and institutions more comfortable dealing with permitted issuers. It can also make issuer records more consistent with the rest of the financial system. For a business that wants to accept regulated stablecoins, that trust layer matters. If the issuer is supervised, reserves are governed, and direct customers are identified, the stablecoin begins to look less like a risky offshore crypto chip and more like a compliance-ready payment instrument. But there are real trade-offs. First is privacy. Crypto users are used to the idea that a wallet address can hold tokens without opening an account with every token issuer. If identity rules expand too far, users may worry that ordinary payments become tied to large identity databases. Second is friction. More onboarding means more forms, more waiting, more rejected applications, and more data security risk. Every database of identity documents becomes something that must be protected. Third is cost. Large issuers can hire compliance officers, lawyers, and vendors. Smaller issuers may struggle. If the cost of becoming a permitted issuer is too high, the market may concentrate around a few very large players. Fourth is the unresolved secondary market question. Some policymakers worry that the biggest illicit finance risks can happen after tokens leave the issuer, because stablecoins can move through self-hosted wallets, offshore platforms, and decentralized protocols. The proposal recognizes the practical challenge. Issuers often do not have a direct relationship with every secondary market user, and there is no central identity desk on a public blockchain. That is the hard policy puzzle. If rules only cover direct issuer accounts, they may miss some activity. If rules try to cover every secondary transfer, they may break the open nature of blockchain payments, or push activity to less transparent places. This is why the comment period matters. Agencies are asking for feedback before finalizing the rule. Industry groups, banks, stablecoin companies, privacy advocates, compliance experts, developers, and ordinary users can argue about where the line should be. For beginners, the most useful way to remember the rule is this. The token can move like crypto, but the issuer may be regulated like a financial institution. Your wallet signs transactions. The smart contract updates balances. The issuer manages minting, redemption, reserves, and direct relationships. The proposed CIP rule attaches identity checks mainly to those direct relationships, not to the simple fact that a token moved from one blockchain address to another. That could still change as rulemaking continues. The final version could clarify definitions, adjust the treatment of redemption, address secondary market risks differently, or connect with other anti-money laundering and sanctions rules under the Genius Act framework. So avoid two extremes. Do not assume this proposal means every stablecoin transfer now requires uploading your passport to the issuer. That is not what the current draft says. But also do not assume stablecoins will remain separate from traditional financial compliance. The direction of travel is clear. Regulated digital dollars are being pulled into the same policy world as banks, payment companies, and money transmitters. The big question is whether the US can build stablecoin rules that support safer payment infrastructure without turning every wallet interaction into a bank account. That balance will shape who can issue stablecoins, who can redeem them, how payment apps integrate them, and how much privacy users keep when digital dollars move on public blockchains. If you have questions about stablecoins, the Genius Act, or how identity rules work in crypto, drop them in the comments. And if there is another crypto policy topic you want explained next, suggest it below.